Welcome to The Explainer. Today, we're diving into a really fascinating and honestly pretty massive shift in the global financial landscape. We are tracking the European Central Bank's unexpected hawkish pivot. And look, this isn't just some dry story about policymakers sitting around a big table in Frankfurt. Not at all. This is a full-on journey that starts with local, sticky inflation and explodes into sweeping global consequences. Consequences that are literally forcing markets worldwide and very likely your own investment portfolios to completely rethink their strategies. So let's cut through the noise and figure out exactly what this complex financial shockwave is all about.
So, thought the era of interest rate hikes was over? Yeah, I think a lot of us did. After years of seeing inflation cool down and markets eagerly banking on lower rates, the general assumption was that central banks were finally taking their foot off the brake. But, well, recent events have completely flipped that monetary policy landscape totally on its head. That whole narrative of imminent rate cuts, it vanished practically overnight, and it's been replaced by a much tougher, way more aggressive reality.
Okay, let's take a quick look at our roadmap for today. We'll start with number 1, the inflation surge returns. Number 2, the ECB signals further tightening. Number 3, markets reprice borrowing costs. Number 4, the global ripple effect. And finally, number 5, what it signals for markets. Let's get right to it.
Starting right at the beginning with section 1, the inflation surge returns. 2%. That is the absolute magic number. It's the European Central Bank's ultimate stubborn target for inflation. And for a little while there, it really looked like we were comfortably gliding back down to it. You know, central bank forecasting can sometimes feel a bit like throwing darts while blindfolded, but everyone was genuinely feeling pretty confident. The reality today, though, is totally different. The data is showing us that inflation hasn't just spiked because of energy alone anymore. Those underlying price pressures have frustratingly spread, and they are lingering stubbornly above that critical 2% threshold. And let me tell you, when underlying inflation just flat out refuses to budge, central banks get very, very nervous. Let's actually break down what's driving this surge right now. We've got a couple of main culprits. First, there's a sharp and frankly painful rise in oil and energy prices. And obviously, that doesn't happen in a vacuum. It is directly linked to the second point, the ongoing, unpredictable geopolitical tensions in the Middle East, which are just hammering energy markets. But honestly, the most concerning part for the ECB is the third driver. It's those spreading, underlying, broad price pressures. It's bleeding into the broader economy like a stubborn weed that you just can't pull up. It's raising some very genuine fears among policymakers that this inflation isn't just a transitory little blip anymore. It's becoming a persistent, entrenched feature of the whole European economy. Which leads us perfectly into Section 2, ECB signals further tightening. This timeline gives us a really clear picture of how rapidly the ECB's response is accelerating. Just 24 hours before the source analysis dropped, the ECB actually raised interest rates again, a direct response to those accelerating price pressures we were just talking about. But they absolutely didn't stop there. Looking ahead to July 2026, senior policymakers made it explicitly clear that the door remains wide open for yet another hike. And looking even further down the road to September 2026, markets are already identifying that as the most likely window for the next rate increase if inflation stays stubborn. So further tightening, it's not just some vague threat. It is firmly, solidly on the table. Just listen to the sheer resolve in the language here. Bundesbank President Joachim Nagel stated flat out, policymakers must remain prepared to act if inflation dynamics deteriorate further. That is not your typical watered-down central bank doublespeak. That is a very direct, authoritative warning. It strongly reinforces that the institution is absolutely willing to aggressively tighten policy again if they have to. They are drawing a massive line in the sand. So we know exactly what they're saying in the boardroom. Let's pivot to Section 3, markets reprice borrowing costs. Talk about a dramatic whiplash happening right now. The old market expectation was basically rosy, right? Easing inflation, lower rates, and everyone just sitting around waiting for imminent rate cuts. It was supposed to be a sweet return to easy money. But contrast that with the new market reality. Renewed, sticky price pressures, a harsh acceptance of higher for longer borrowing costs, and, like we noted, a potential September hike. It's been this sudden, jarring plunge from years of easing expectations right back into a highly restrictive, high-rate environment. And the reaction across the financial markets? Immediate and intense. Investors are rapidly scrambling to reassess the entire path of European interest rates. As a direct result of that panic, bond yields across the euro area are just remaining stubbornly elevated. Money is moving incredibly fast, entirely driven by these increased expectations for prolonged, higher borrowing costs. It's a sudden, super high-stakes adjustment as literally every investor out there tries to align with this new reality. And hey, if you're holding bonds or tracking mortgage rates yourself, you are feeling the direct, real-world impact of this recalculation right now.
Time to zoom out and look at the bigger picture with Section 4, the global ripple effect. Because what happens in Frankfurt definitely does not stay in Frankfurt. Think of higher European interest rates like a massive, heavy stone dropped right into the middle of a pond. The ripples travel absolutely everywhere. When it comes to capital flows, those higher rates in Europe totally shift the attractiveness of euro-denominated assets on a global scale. All of a sudden, European bonds look like an amazing deal, and that draws money away from other regions. In terms of corporate financing, it actually drives up government and corporate borrowing costs globally. Money just becomes fundamentally more expensive for businesses to borrow. And in currency markets, it triggers intense worldwide volatility as investors constantly readjust their positions based on these shiny new yields. The ECB's stance literally influences the movement of money way, way beyond Europe's borders. And this creates a really stark global divide. In developed markets, like Europe itself, higher rates obviously offer higher yields. That acts like a giant magnet, highly encouraging global investors to move their funds toward these lower-risk, newly profitable assets. But then you have to contrast that with emerging markets. The source data specifically points out countries like South Africa. They are suddenly facing intense, seriously increased competition for global investment flows. I mean, when an investor can get a great, perfectly safe return over in Europe, it becomes so much harder for emerging markets to attract that capital. And that forces in really tough capital allocation decisions, putting tremendous pressure on those local economies. Which brings us to our final stretch, Section 5, what it signals for markets. Let's synthesize the absolute ultimate takeaways here. The crucial point is this. Inflation has once again become the dominant concern. It has completely and utterly replaced any hopeful discussions of rate cuts. Central banks are officially, without a doubt, back in full-on inflation-fighting mode. This energy-driven inflation is sticking around, and policymakers have made it abundantly clear that they are not just going to ignore it. So how do we actually navigate this? Well, the source analysis gives us a very clear three-step playbook to prepare for this exact environment. Step 1, accept that central banks are currently debating additional increases, not cuts. The paradigm has completely shifted. Step 2, you need to adjust for borrowing costs staying elevated for an extended period. Higher for longer is absolutely the new mantra you need to memorize. And step 3, prepare for continued, highly unpredictable volatility across bond, currency, and equity markets as the entire world scrambles to adjust to the cost of capital going up. To wrap up this explainer, I really want to leave you with a final, provocative thought to chew on. Are global markets truly prepared to sacrifice economic growth for the sake of stable prices? Because ultimately, at the end of the day, that is exactly the tough, brutal choice the European Central Bank and central banks worldwide are currently making. They are prioritizing price stability, even if it explicitly means slowing down the broader economy. Keep that exact question in mind as you watch your own portfolios of the coming weeks, and always keep seeking to understand the why behind the numbers. Thanks for joining me.